All right, hello everyone. This is DayTraderRockStar for DayTradingRadio.com. I want to talk about stochastics divergences tonight. Here's a chart of Sybase, SY, and we're going to break this chart down for you and show you how to pick out a top here and kind of work out the overall trading pattern of the stock. Now, looking at this stock, you can see there's an uptrend here that we're rolling up against the 20-period moving average. We bounce off of it here. We bounce off of it here. We start trading around it here. And then at this point, we drop off here. So how do we know that we're going to drop off at this point and not move up? All right, this is an interesting question. First of all, there's a couple different clues that we get here. If you look here, you can start to develop a trend line here. Now, this is a very powerful pattern here. A lot of people talk about the head and shoulders pattern, but I talk about the slanted head and shoulders pattern, where you get a nice high head there, and nice little shoulder level there, and basically you got the uptrending line here, which is a stronger breakdown when it breaks down on the uptrending line. But how do we know this is going to break down here? Well, one of the clues that's going to happen here, and I want to show you this right now, is when we make this high here. You notice this indicator up here is the stochastics. These are the full stochastics, and these are set at 4, 3, and 3. And we'll get more into that in a different video, basically describing what they are. But it's an indicator that I use. And we get up above the 80 to 90 level, up into the 100 level, we become what's called an overbought level. And if we get down to the 20, underneath the 20 level, we become what's called an oversold level. Now, as a strong indicator, I wait for those extreme levels to line up with another support line or a resistance line to kind of trigger a trade. So it's just, I don't work on the stochastics alone. I work on a stochastics pulling back to this area here where you know it's getting oversold, and the market is actually pulling back to a trend line. So two indicators saying that the market's probably going to bounce here. And we did get a nice bounce here. Now, how do we know that we don't continue to move up here? Well, the stochastics get back up into a level, an oversold level here. We move right back up into an oversold level, but the high, the market high here, which we're going to put right here, the little high here is lower than this high here. All right, so what we're going to do, we're going to show you right here, this little high here that happened back here. I want to put a line there, and you're going to see that high is basically higher than this high right there. But the stochastics both came up pretty much to the same level. So that's called a divergence. When the stochastics get up to an overbought level, but the market doesn't make a new high. Basically, you want to see a market continue to make new highs and be in an uptrend. But once the stochastics get into an overbought level, yet the market doesn't make new highs, that's a divergence. Now, the stochastics were originally developed as a divergence indicator. A lot of people now use them as an overbought or oversold indication, but the original, when they were developed in the 1950s, they were used as a divergence. Excuse me. And again, the divergence is if the stochastics become overbought and the stock market hasn't, or the stock or the index or whatever you're trading off of them, hasn't made new highs, yet the stochastics are back up to that's the divergence. So that's your real big clue that the market's probably getting weaker here. You have a trend line here, and once we break through that trend line, as I like to say, all hell break loose and we're moving down. And now we move down here off of this level, and we move to a major moving average, which is the 200-period moving average, and we got a nice bounce off of that. So again, it's just important to know your stochastics, know your trend lines, know your divergences. If you can recognize the divergence, have the patience to get into a trade. Watch your moving averages, the standard 20, 50, 200-period moving average. You can see how the market hesitated here at the 50, moved up to the 20 and failed. That's called a classic bear flag. All right, we had a little bear flag right here, and we moved up and we broke down, and then we used that 20-period moving average underneath us. Now the stochastics are pulled back into an oversold level. We're holding off a major moving average. We got a nice bounce. And again, if you could just, it doesn't mean that you have to trade in between these levels, but if you could trade when you see these indicators I like to call, and trade off them, you're gonna profit them in the markets much better than just taking random trades. So Hope you enjoyed that tip. This is DayTraderRockStar for DayTradingRadio.com. Come by the site. I broadcast the site every day. These setups, as they happen, live. The radio's live and free. Hope you enjoy it.